Hey, what's up, my friend? So in today's episode, I want to share with you, right, the top 5 mistakes, right, that most forex traders make, most beginning forex traders make. Number 1. Hey Rayner, I want to make 10 pips a day, man. Rayner, I'm not greedy. All I'm asking is just 10 pips a day. After all, right, the pound dollar moves 100 pips a day. All I want is just 10 pips. I'm not greedy. Now here's the deal. It doesn't matter whether you want to make 2 pips a day, 5 pips, 10 pips, 50 pips. In order for you to make X number of pips a day, it means that your trading strategy has to work, right? It has to be able to take advantage of certain market patterns right now, certain market conditions. For example, if the market is in an uptrend and your trading strategy is a long strategy that, buys breakouts, buy high and sell higher, you'll make money. Maybe if you buy the pullback, you buy on the retracement and you sell higher, you'll make money, right? Because that uptrend market condition is suited for that trading strategy that you're using. So yes, you'll make pips, you'll make money. But guess what? Market conditions, they change. It could be in an uptrend for the last 5 days, the last 10 days, but it's not going to go up forever. You will eventually go into a range, you might go into a downtrend. And here's the thing, you never know when that will happen. So yeah, you could be making, pips consistently for 4, 5, 6, 7, 8, 9, 10 days. But when market conditions change, your trading strategy stop working. And guess what? You're not going to make, that consistent X number of pips each day again. Okay, until you can adapt to the new market environment, the new market condition. Okay, so first and foremost, right, don't focus on making X number of pips each day. Instead, you should focus, right, on making money. That's number 1, definitely, right? But when your losses come, right, you should also focus on containing those losses such that, you make good money on the good days and you have enough, right, for the rainy days, right? That's how this game is played, right? It's not all about making every day a certain number of pips, because that's just not going to happen. Number 2, right? A mistake that many traders make is that they think that they can trade full-time with a $1,000 account, because there's this thing called leverage, right? You can leverage your $1,000 trading account, leverage 1 to 500. So in essence, you're controlling $500,000 worth of currencies. Well, if you haven't realized it by now, leverage is a two-edged sword, right? Yes, you can make more money because you are controlling more money. Well, technically you are not really controlling, but it appears the illusion that you're controlling more money. But at the same time, right, you can also potentially lose more money. Your losses, right, can even be amplified and go against you faster had you not used leverage. So don't get the wrong idea that just because you have leverage, just because, you have a 1 to 100, 1 to 500 leverage, you can trade full-time with a $1,000 account. That's not going to happen. Again, that's because when your losses come, right, it can easily wipe out your profits and more. So don't have the fixed idea of, $1,000 is all you need. You really need much more than that, right, to trade full-time, right? And on top of it, we're also talking about having the skill, right, to become a consistently profitable trader. That's something that's required as well, not just the size of your account. The third thing, right, most new traders, they focus a lot on indicators. After all, indicators are sexy, right? You look at your charts, the line goes up and down, right? Whoa, that's fun, that's exciting. But take a step back and think, right, how are those indicators derived on your chart? If you think about this, right, indicators, they are derived, most of them are from the price, either from the open, high, low, or close from the price. So when you apply a mathematical formula to the price, that's where you get your indicator value. And when you see your indicator values and you use it to make buy or sell decision, you're usually one step behind someone who can just read off the price charts. So I'm not saying indicators are bad. They have their users, like, in trade management, trailing stop loss and stuff like that. But if you only solely look at indicators to make your buy and sell decisions, right, then hey, right, that's you have to understand that you'll always be one step behind someone who can just read off the naked price chart. All right, so that's the third thing. The fourth thing, right, that many new traders do, right, a mistake, is that they micromanage their trades. For example, let's say you're a trader who trades off the daily time frame. Right, you have a valid trading signal, you go long, you buy. And what happens is that you start to get anxious, right? The market stalls, right? It's not moving very much. It retraces slightly against you, and you start to panic, you start to sweat. So what do? Right? You start to, analyze the price action more deeply. You go down to the 5-minute time frame and see how the price action is like. And clearly, when you from the daily time frame, which is your entry, and you go down to the 5-minute time frame to look at the price action, you're going to get scared out of the trade, right? Because the retracement against you on the daily time frame will look like a freaking downtrend on the 5 minutes chart. And you think, oh, the move is over, the trend is over, let me get out of the trade, let me, take this small loss and move on. And the next thing you know, the market reverse rally and you hit your target profit. And that's because you were micromanaging your trades. So here's the deal, right? If you trade off the daily time frame, the lowest time frame that you want to manage your trade is on the daily time frame, right? Don't go down to the 5 minute, don't go down to the 15 minutes, because more often than not, you'll scare yourself out of the trade. Okay? And the fifth and final thing that I want to share with you is that many new traders make the mistake of just focusing on their winning rate. After all, they think their winning rate is everything, right? I'm looking for a strategy with a minimum of a 70% win rate, 80% win rate. Now, here's the thing, right? You can have a 90% winning rate strategy, but in the long run, you'll still lose money. You might be wondering, hey, Rayner, how is that possible? Very simple, right? Let's say you have a strategy that wins 9 times out of 10. Each time you win $1. But at one time when you lose $50. If you do the math, that one loss, right, will more than wipe out all your open profits that you have accumulated over time, or all the profits that you have booked over time. So that's why you shouldn't just focus only on your winning rate. You should focus instead on two things. Number one, your winning rate, and number two, your average gains, right, to average losses, otherwise known as your risk to reward ratio. That's what, right, will give you the complete picture, right? Because number one, you know how often you win, and number two, right, you know how much you win when you're right and how much you can lose when you're wrong. And that gives you a good, complete idea, right, to whether you have an edge in the markets. Okay, so focus on this, alright? So with that said, right, I hope this episode helps. I think some of you want a quick recap. So number one, again, forget about making X number of pips each day, because that's not how it works. Instead, focus, alright, on trading well, right? Making as much money as you can when market conditions are favorable to you, and then playing good defense, right, when market conditions turn against you. That's number one. Number two, forget about trading full-time with $1,000 account or $500 account, right? Just because you think you have leverage doesn't mean that, you know, you can stretch that account, right, to whatever needs you want, right? It's not going to happen, okay? Number three, when you first started trading, right, when you first start trading, don't focus on indicators. Focus on the price, all right? Because the indicators are a derivative of price. Once you've understand, right, how the price action works, then yes, you can look into indicators, right, to make your life, you know, easier, right, to simplify certain aspects to it, like trade management, risk management, etc. Fourth thing, right, don't micromanage your trades, right? If you trade off the daily time frame, the last thing you want to do is go down to a lower time frame, like the 5 minutes time frame, to micromanage your trade, because you'll probably scare yourself out of the trade. And finally, the fifth thing is don't just focus on your winning rate, right? It's your winning rate combined with your risk to reward. That's what gives you the full picture. So with that said, I wish you good luck and good trading. I'll talk to you soon.